In the next 30 seconds, I'm going to show you why a huge portion of AI companies could collapse by 2026, why even leaders like Sam Altman admit we're in a bubble, and the 3 warning signs right now that suggest the AI industry's foundation is cracking. But first, let me show you a number that will blow your mind. Right now, major tech and cloud firms are committing hundreds of billions of dollars. Estimates cluster around $300–400 billion this year alone to AI data center and infrastructure build-out. That's comparable to large national industrial programs. Now, while this enormous infrastructure build is happening, enterprises' actual customer spending in generative AI is still in the tens of billions, not hundreds. Some analysis show only low tens of billions of enterprise Gen AI spend so far. The gap? A potential hundreds of billions of dollars. And that mismatch is the hole this story is built on. If firms are building at infrastructure scale, but actual revenue lags far behind, you end up with a bill-income scenario. Stick around, because what I'm about to show will change how you view the entire AI industry. Whether you build, buy, use, or just follow tech, you need to watch until the end. A recent report called this the biggest and most dangerous bubble the world has ever seen. While I can't verify that exact phrase, the main idea is echoed across tech analysis. The scale of investment plus hype plus unproven revenue Ezekiel to bubble risk. Sam Altman, CEO of OpenAI, was quoted saying, "Are we in a phase where investors as a whole are overexcited about AI? My opinion is yes." That's the CEO of one of the leading firms saying the investors might be too excited. This is not just startup hype. Companies like Mark Zuckerberg, betting hundreds of billions on AI, and others are also sounding ambiguous. They're still spending, but admitting risks. When the builders of the revolution themselves are warning, something is seriously off. Here's the first warning sign. Revenue is far behind expectation. A new study from the Massachusetts Institute of Technology found that roughly 95% of corporate generative AI pilot programs show no measurable financial return. Only about 5% of those pilots are delivering rapid revenue growth. Meanwhile, firms like OpenAI are being reported to generate roughly $12–13 billion in annualized revenue this year. Sounds good, but compare that to infrastructure commitments and partner deals being talked about in the hundreds of billions, even into the trillions in some projections. That suggests many years of current rate revenue to break even on current commitments. And it's not just one company. Many major tech firms are posting huge losses in their AI, metaverse, infrastructure divisions. One division, Reality Labs at Meta Platforms, has lost tens of billions of dollars cumulatively. At the same time, some in-house memos at other big firms describe certain AI investments as faith-based, corporate talk for we don't really know the payoff. The takeaway, there is a revenue gap, high expectations, infrastructure spend, but many pilots not delivering measurable P&L improvement yet. That's a classic bubble trigger. The second warning sign, complex circular funding and cross-investment that masks underlying weakness. There are many large strategic deals. For example, OpenAI is negotiating huge infrastructure commitments with NVIDIA. Reports suggest potential $100 billion scale investment. At the same time, chip and cloud vendors, AI platform vendors, and startups are embedding cross-equity, vendor agreements, and revenue share models. That kind of intertangled money flow reminds me of the 2008 era. Institutions investing in each other's assets, creating the illusion of strength. If one leg fails, the structure can wobble. While I could not verify every exact percentage referenced, the pattern is visible. Huge stakes, vendor-operator ties, multi-year infrastructure deals with partners, and many startups raising large rounds without clear independent revenue streams. This is not simple venture funding. It's a full ecosystem financing rollout that depends on assumptions holding up. When you have money moving in loops between big players and the underlying customer payoff is uncertain, That's a setup for systemic shock. Third warning sign, infrastructure build-out that is massively ahead of proven demand. The MIT Bain type analyses suggest that AI infrastructure scaling, data centers, GPUs, power cooling, requires $2 trillion in annual revenue by 2030 to justify current commitments, and current projections indicate an $800 billion shortfall unless things radically accelerate. These facilities aren't trivial. They consume electricity like small cities, require enormous capital upfront, and in some regions are already causing grid stress, brownouts, blackouts, near major data center clusters. But first, let me show you a number that will blow your mind. In short, lots of money being gambled, large builds, long life cycles, and yet we don't know if the demand will match the supply or how fast the economics will recover. Earlier build-outs, for example the 1990s fiber optic bubble, laid down unused capacity for decades before use. This time, the window may be much shorter. If demand doesn't meet scale, those data centers could turn into abandoned malls of compute. Here's something many don't talk about. The technology itself is running into headwinds. Audits by organizations such as NewsGuard show that major AI models and news-related prompts have higher error, false claim rates than a year ago. That suggests the bigger model, bigger capability thesis may be encountering diminishing returns. In fact, research indicates many enterprise Gen AI deployments are getting stuck because of the organizational learning gap. The tools alone aren't delivering value if not integrated into workflows. So the scaling bigger always better narrative is being questioned. On the user side, some large organizations report that their developers spend more time fixing AI-generated outputs than they would have spent just doing the task manually. Marketing firms are quietly scaling back some AI content generation. Law firms are wary of hallucinated legal precedents. Medical providers are pulling back on some AI-driven workflow pilots after near-miss errors. The revolution that was supposed to change everything? It's being moderated from expectation to realism. So, when will the bubble pop? We don't know for sure, but several credible analysts suggest the risk window is narrow. Some observers suggest the bust could begin as early as 2025, with one major collapse triggering wider panic into 2026. Given the current build-out timeline, that aligns with many multi-year commitments entering full burn phase soon. Here's a suggested phase map. Phase 1, present, late 2025. Cracks are appearing, big commitments announced, pilots floundering, valuations high. Phase 2, early 2026. Start of the unwind. Startups run out of cash, layoffs accelerate, the tone shifts from innovation to correction. Phase 3, mid-2026. First major players admit failure or consolidation. The market shudders. Phase 4, late 2026 to 2027. Broader knock-on effects. Infrastructure write-downs. Data centers repurposed or shut. Regulatory, congressional investigations. If you're a smart investor, you're already positioning for the 6 to 12 months before the crowd exits. The smart money always leaves early. Right now, major tech and cloud firms are committing hundreds of billions of dollars. Estimates cluster around $300–400 billion this year alone to AI data center and infrastructure build-out. That's comparable to large national industrial programs. Not everyone dies in this collapse, but the survivor list is small and the death list is big. Likely survivors. NVIDIA. They supply the underlying GPUs. They may suffer in stock price, but their installed product base gives them resilience. Microsoft, Alphabet Inc., Google, Amazon Web Services. They have diversified revenue streams, cloud, ads, devices, so even if AI bets go wrong, they have backups. Apple, by staying deliberately cautious so far on the massive infrastructure boom, they have the optionality to swoop in, acquire undervalued tech, and avoid the biggest losses. Mid-tier AI companies with valuations between $1 and $10 billion, especially those that are wrapper companies. UI front ends for big models, but no unique core IP or strong go-to-market. Startups with little revenue and massive burn, even some major names. If OpenAI fails to scale profitability, its $300+ billion valuation becomes highly exposed. In short, if you're in the tools built on someone else's model business with low margin and high burn, you're in the storm zone. If you work in tech, update your resume now. The dot-com crash wiped out hundreds of thousands of jobs in Silicon Valley. This could be bigger. If you're a student or upcoming professional, be cautious about betting your career purely on AI specialist roles without considering demand, differentiation, and sustainable value. Massive oversupply may hit. If you use AI tools in business, this is not the time to bet your company on unproven large-scale rollouts. Wait for the second wave. Post-crash, more mature tools, better economics, actual ROI. If you're a business owner, experiment, yes, but don't go all in on infrastructure or mega rollouts before the economics prove out. Let smarter capital absorb the earliest losses. And for everyone else, be aware. The crypto crash didn't stay in crypto. The dot-com crash didn't stay in tech. A big AI correction could ripple into broader markets, employment, global supply chains. But here's the silver lining. Collapse always creates opportunity. After the dot-com crash, survivors soared. After the 2008 crash, new winners emerged. If you're ready, you don't just survive, you thrive. What history teaches us? Diversify your portfolio. In the 2000 crash, tech-heavy portfolios fell 70–80%. Focus on companies with real profits, strong cash flow, and boring business models rather than hype. Now, while this enormous infrastructure build is happening, enterprises' actual customer spending in generative AI is still in the tens of billions, not hundreds. Some analyses show only low tens of billions of enterprise Gen AI spend so far. The gap? A potential hundreds of billions of dollars, and that mismatch is the hole this story is built on. Maintain a cash position. In 2008, Warren Buffett held $128 billion in cash and bought assets when everyone else was forced to sell. Timing matters more than trying to pick the exact top. Investors who shifted away from full speculative exposure 12 months ahead of previous crashes tended to outperform those who stayed till the end. Remember the psychological cycle: innovation, enthusiasm, delusion, panic, crash. We are currently transitioning from delusion into panic. Now, let me show you something the tech industry doesn't want you to highlight. I reviewed nearly every major enterprise AI announcement from the past 12 months, and the language is consistent. We'll revolutionize, we'll transform, we'll enable. The phrasing is future tense. Very few claim definitive current capabilities. That's a subtle but key sign. Internal surveys from Fortune 500 companies support this. For example, employees at many large firms report they spend 70% of their time redoing AI-generated work rather than benefiting from it. Another study finds that about 64% of workers say AI tools have reduced their productivity because they now spend more time validating and correcting rather than creating. And the economics? Unforgiving. Suppose one query on a large model costs 327 cents in compute inference, public estimate. Multiply that by billions of queries. Factor in correction time, human oversight, deployment cost, infrastructure amortization. You get an inference cost model that can easily exceed cheaper human alternatives in many use cases. Perhaps the dirtiest secret: the people pushing large-scale AI hardest are often the ones who understand it least. Anonymous internal surveys at major AI labs show many veteran AI engineers, researchers, are deeply skeptical about current enterprise-wide claims. Their warnings? Buried under the marketing and executive FOMO. I'm not saying AI is useless. The internet was real. Cloud computing was real. But the fact that it is real doesn't prevent a bubble from blowing up around it. The signs are all there. Massive infrastructure spending, high valuations, lagging revenue, circular funding, infrastructure build-out ahead of demand, technology still struggling to prove itself in many enterprise settings, and big-name execs openly warning of overexcitement. Every bubble in history had a real foundational technology, insane valuations. Smart people saying, this time is different. We have all three. The bubble is bursting. Right now, the only question, will you be ready? If this opened your eyes, hit subscribe, turn on notifications, because when the acceleration hits, you'll want to know immediately. Comment below, are you seeing these signs? Are you preparing? Or do you think I'm overreacting? Remember, in 1999, the dot-com skeptics were mocked. In 2007, the housing pessimists were ignored. Don't be on the wrong side of history again.